Have you ever wondered why wealthy Canadians seem to keep more of their money while the rest of us scramble to pay taxes? It's not just luck or higher earnings. It's smart tax planning that most people overlook. Here's a jarring fact. The average Canadian business owner pays 30 to 40% of their income in taxes, while the wealthy often slash that number by half through strategies anyone can use. I recently met a client who was losing $50,000 a year to taxes because they didn't know the tricks wealthy Canadians use to protect their wealth. The good news? You don't need to be a millionaire to save big on taxes. In this video, I'm revealing 6 tax planning mistakes most Canadians make and the secret strategies wealthy Canadians use to overcome them. From business structures to investment hacks, I'll share real examples, stats, and actionable steps to help you keep more of your hard-earned money. Whether you're a business owner, investor, or planning retirement, these insights will change how you approach taxes. Stick around, because this could save you thousands and set you up for a wealthier future. Hi, if you're new here, my name is Charles Lacalzi, Associate Investment Advisor at IA Private Wealth, Zenith Private Wealth Council. If you want to pay less taxes and build more wealth, this channel is for you. So hit the like button, subscribe, and let's dive in. Tax planning isn't just for the ultra-rich. It's a game changer for any business owner who wants to help, who wants to keep more of their money. Wealthy Canadians know how to navigate Canada's complex tax system to minimize their tax bills while maximizing their wealth. But most Canadians miss these opportunities, paying thousands more to the CRA than they need to. Let's break down 6 common tax planning mistakes and the strategies wealthy Canadians use to stay ahead. Problem number 1, ignoring tax-advantaged accounts. Most Canadians underuse accounts like TFSAs and RRSPs, leaving tax-free or tax-deferred growth on the table. Business owners often reinvest profits into their company, thinking it's the best way to build wealth. Wealthy Canadians prioritize these accounts to shield their money from taxes. Here's how to tackle it. Max out your TFSA and RRSP contributions every year to build tax-efficient wealth. In 2025, the TFSA limit is $7,000, and RRSP limits depend on your income, often $30,000 or more for higher earners. TFSAs are perfect for flexible withdrawals as they're tax-free and don't impact benefits like OAS. RRSPs or IPPs, individual pension plans, offer tax deductions now with taxes deferred until withdrawal. Funnel excess business profits into holding company, then transfer funds to TFSAs for tax-free growth. A client who started this at the age of 45 built $600,000 tax-free nest egg by 65 at a 5% rate of return. Meet with a financial planner to integrate these accounts to your wealth plan. Problem number 2, not using business structures to defer taxes. Many business owners pay themselves high salaries or dividends, triggering personal tax rates of up to 50% in provinces like British Columbia. Wealthy Canadians use corporate structures to defer taxes and keep more money working for them. A client with a consulting business paid $100,000 in personal taxes yearly by taking a large salary. They didn't realize a holding company could save them $30,000 annually by deferring taxes. Without a smart structure, you're handing the CRA money that could grow your wealth. So what can you do? Set up a holding company to retain business profits at lower corporate tax rates, often 12 to 20%. Invest those profits inside the company in stocks, real estate, or bonds, deferring personal taxes until you withdraw. Pay yourself a tax-efficient mix of salary and dividends to stay in lower tax brackets. For example, a client who used a holding company deferred $40,000 in taxes yearly, reinvesting it for 7% growth. Work with an accountant to structure your business for maximum tax savings. Ensure your company complies with CRA rules to avoid penalties like passive income limits. Problem number 3, missing the Lifetime Capital Gains Exemption or LCGE. The LCGE is a hidden gem for business owners, but most miss it due to poor planning. In 2025, you can shelter up to $1.25 million in capital gains from selling qualifying small business shares tax-free. But strict CRA rules, like holding 90% active business assets, trip up many owners. A client who sold their tech startup paid $250,000 in taxes because they didn't qualify for their LCGE. Wealthy Canadians plan years ahead to unlock this tax break, saving hundreds of thousands. Let's fix this. Start LCGE planning 3 to 5 years before selling or transferring business shares. Confirm your business meets CRA criteria, ensuring most assets are used in active operations, not investments. Sell off non-qualifying assets like excess cash or rental properties to purify your company. Transfer shares to a family trust or spouse to crystallize the exemption, working of course with a tax advisor. A client who did this saved $350,000 in taxes, boosting their retirement funds. Engage a tax professional early, as LCGE eligibility requires a 24-month holding period. Problem number 4, overpaying taxes on investment. Most Canadians hold investments in non-registered accounts, paying 20 to 30% tax on interest, dividends, or capital gains. Wealthy Canadians use tax-efficient investments to minimize these costs and grow their wealth faster. A client with a manufacturing business had $500,000 in a non-registered portfolio, paying $15,000 in taxes yearly on interest income. Switching to capital gains-focused investments could have halved their tax bill. Without a tax-smart portfolio, you're losing money that could compound over time. Here's how to make it work. Prioritize investments that generate capital gains, which are taxed at half the rate of interest income. Hold Canadian dividend stocks in non-registered accounts as they qualify for the dividend tax credit. Use TFSAs or RRSPs for interest-heavy investments like bonds or GICs to avoid taxes. Practice tax loss harvesting, selling losing investments to offset gains, reducing your tax bill. A client who optimized their portfolio saved $10,000 annually in taxes, reinvesting it for 6% growth. Work with an investment advisor to design a tax-efficient portfolio tailored to your goals. Problem number 5, not leveraging income splitting. Many business owners miss opportunities to split income with family members, keeping their taxable income high. Wealthy Canadians use legal strategies to distribute income to lower tax bracket family members, saving thousands. A client paid $80,000 in taxes yearly because they didn't split dividends with their spouse, who was in a lower tax bracket. This oversight cost them $20,000 annually in avoidable taxes. So what can you do? Pay a reasonable salary to your spouse or adult children for work in your business, reducing your taxable income. Issue dividend-paying shares to family members in lower tax brackets through a family trust, ensuring CRA compliance. Use spousal RSPs to contribute to your spouse's retirement, claiming tax deductions while splitting future income. For example, a client who split $50,000 in dividends with their spouse saved $15,000 in taxes yearly. Consult a tax advisor to set up income splitting strategies that meet tax rules like TOSI, tax on split income. Start early to maximize savings over time, as trusts take time to establish. Problem number 6, going it alone without expert guidance. Tax planning is complex, and most Canadians try to handle it themselves, missing key opportunities. Wealthy Canadians rely on a team of experts to optimize their tax strategy and avoid costly mistakes. A client with a construction business paid $70,000 extra in taxes yearly because they didn't have a coordinated plan. With professional help, they could have saved that money and grown their wealth. Here's how to tackle it. Work with a team of professionals, a financial planner, tax accountant, and lawyer to create a holistic tax plan. Integrate strategies like TFSAs, holding companies, LCGE, and income splitting into a unified approach. Review your plan annually to adapt to tax law changes for personal goals. Use financial software or an advisor to project tax scenarios, keeping you in lower tax brackets. A client who worked with a team cut their tax bill by $60,000 a year, securing their retirement. Start building your team now, ideally 5 to 10 years before retirement, to maximize tax savings. Wealthy Canadians succeed because they plan proactively using smart strategies to minimize taxes and build lasting wealth. By avoiding these 6 mistakes, ignoring tax-advantaged accounts, missing business structures, overlooking LCGE, overpaying investment taxes, not splitting income, and going it alone, you can keep more of your money. If you're thinking of optimizing your tax strategy and want to ensure you have enough to retire, click the link below to book a consultation with me. I'll help you create a personalized strategy so that you can retire with confidence. Drop a comment below. What's the biggest tax planning challenge you're facing right now? I'd love to hear your thoughts.